Let's talk to Tim Gregory. He's the founder and chief investment officer of Vermeer. Tim, Happy New Year to you.
Happy New Year, Nick. Good
right,
morning.
Let's talk about the US of A. It seems to be hitting the headlines, whether it's political or economic. We've got a situation, we've had the dollar falling, we've had a short-term rally, we've got the 10-year money, the yield shooting up, equity markets slipped last night. I see Dow was down 175 and the likes. Okay, is this the beginning of the end? Is this the final 30-year correction in the bond market? What on earth is going on?
Well, as you say, the key to the markets this year has definitely been everything that's been going on in the US, the weakness of the dollar, rising bond yields after, as you say, multi-year bond market, bull market. And that is the question everybody's asking themselves. And it does seem to us like bond yields are now starting to rise again. The fact is that the US economy is growing quite strongly. That interest rates are set to rise this year, as is well known and I think well discounted by the market, that rates go up 2 or 3 times this year. But just as that's happened, we've had these tax cuts that are clearly a benefit to corporate USA, and we've seen a number of companies who are handing out pay rises and bonuses to staff. And the question may be, is this going to pull forward some growth into the US economy to stoke even faster growth at a time when actually the US economy was doing perfectly well already? So that's raising question marks. Is the Fed going to have to tighten policy more aggressively? And are we going to see the increased risk of a policy mistake because the Fed reacts to the short-term very strong growth numbers and then only to discover subsequently down the line that the US economy reverts to the sort of median, slower type of growth that we've seen in the last decade since the Great Recession?
Okay, so I'm looking at my funds. Okay, how do I position myself for 2018?
Well, the way we've positioned ourselves is that for the first time in over a decade, we are modestly, and I emphasise the word modestly, overweight the bank sector, which does reflect rising interest rates. So we haven't by any means bet all in on rising interest rates, because as I do think longer term that there are still some reasons why growth could be subdued, although we're saying that may pull forward in the short term. But in a market which by historical standards, particularly in the US, looks expensive, we can find value in some better quality banks. And the way we've positioned in banks is to own 4 or 5 different banks on a global basis, 2 of them in the US, Citigroup and US Bancorp, which we think is a high quality franchise, and Citigroup is recovering, and things like HDFC in India, Standard Chartered, which is a recovery story in the UK, it's performed quite well this year so far, and in Singapore a bank called DBS. So we've got quite broad coverage. It's not all in the US by any stretch of the imagination, but we have shifted the emphasis in our portfolio more towards that area, and having been so pro-growth in the past, some more value-oriented type ideas, and slightly away from the bond proxy type stocks that have so dominated markets in the last 10 years. So if you think about the revaluation of staple businesses in the last 10 years, because of where bond yields have been and people's expectations of where bond yields and interest rates were going to be, that seems to us to be a more vulnerable area of the market, and we're being careful about that at the moment. Okay, so one other question in terms of sectors, commodities. Obviously, weak dollar, favourable for gold and oil, sort of 2014 highs, 2016 highs. Okay, is that an obvious trade or is that too obvious? Well, it is quite an obvious trade, but it is working in the markets. As you know from when we've come in here in the past, we've talked about stocks like Rio Tinto, things like Newmont mining in the gold sector. And we own those stocks, as I've said to you in the past, not because we necessarily think the gold price is going to take off, but it might if the inflation fears and the dollar continues to weaken, if that accelerates. And not because we think in the case of Rio Tinto that the iron ore price is going to take off, but more because these businesses now are demonstrating really strong capital discipline, that they're generating lots of cash, they're returning that to shareholders, and actually, in a market which is pretty full of very expensive stocks, they look good value to us, particularly if you look at things like EBITDA metrics, they still look quite cheap. So we're actually happy to own that part of the market. We are overweight that part of the market, but it's not predicated on the fact that gold goes back up to 1,800, its previous highs, or that iron ore prices get anywhere near where they were in previous cycles. And in things like oil, we have moved from underweight to closer to a sort of neutral-ish position.
Right.
We've owned things since we launched the fund, like Chevron and like Statoil, so larger cap, more integrated type businesses with good yields, which have lowered their break-even, have got sustainable cash flow and can continue to pay their dividends going forward. And the oil price rising to the current levels that we've seen, sustainable or not, is a bonus to us, not our core reason for owning them.
Understood. Tim, on that note, as always, thank you for your time. We don't see you enough. Hopefully we'll see you in a couple of weeks' time.
Thanks very much, Nick. Good to see you.